Term versus perm. Now, this isn't necessarily outlined clearly in your study notes, but it is something that I like to go through with my clients that helps them to understand the differences between term and perm. And I have some illustrations here to help you understand. So term insurance, it starts on day one. It continues for the length of the term. So let's say that we have a 20-year policy. So it continues for 20 years, and every 20 years it renews and increases in price. And that continues until the end age. So the age that the policy or the insurer that you are working with says that they will no longer cover life insured. And every renewal, that price increases. And the good things to remember about term are that they are it is a temporary policy, so there is an end date. It does not continue forever. It is renewable, so those renewals that you see the little arrows by, and it is convertible. So that means it can be converted into another policy. Now, depending on the insurance company and the policy that you're trying to convert into, it is possible that you do need to provide medical evidence. It's completely based on the insurance company. A lot of insurance companies will allow you to convert from term into permanent without any medical evidence. It is pure insurance, so there's no cash value. These policies do not have any value in them. And there is an age restriction for issue. So that means after a certain age, the insurance company has deemed that the risk is too much and they will not provide a policy for that client. Now, permanent insurance has some different categories or some different types of permanent insurance under them. But in general, what permanent insurance is it starts on day one and it continues for the life of the insured. And you pay the same amount every single month. It does not change no matter what happens. And it is a life policy. Now, there is also a cash value in that policy, which ideally is going to grow over time. And sometimes the cash value in permanent insurance doesn't grow significantly or is zero for the first 10 years of the policy. But over time, it does slowly grow, and it can eventually grow to be quite significant, or it might be minimal. It just really depends on the policy. And T100, so T100 policy, that policy does not have any cash value, but it does stay with you for life. So that's something that's important to remember. A permanent insurance does have higher premiums. It is more expensive because you are paying for that benefit of not having any renewals in terms of how much money you're paying, and in order for the benefit for it to stay with you for life. There are more options or benefits. So there are riders and supplementary benefits and things that you can add onto your policy, more bells and whistles that will allow this policy to really be customized and catered for exactly what your life insurance needs are. There are three types of policies that we are going to go through in the life insurance module: whole life, T100, and universal life. Really quickly, a way that I explain a universal life policy is sort of with this little bucket here. And if you want to think of it, that your premium, the premium, which includes the cost of insurance and potentially some investment money, is put into a bucket. And that bucket is called a fund. And that fund, it stays in there and grows and is invested. And every month or every year, depending on what your client chooses their payment option to be, the cost of insurance is taken out and paid to the insurance company. What remains in there is the investment, and so that investment grows over time, and that's sort of a very, very basic way to explain a universal life policy. The big differences between the two are how to sort of figure out when to use one versus the other. So term insurance, all short-term insurance needs. So that's mortgage, debt, child support, child education. If you have some sort of spousal support that's mandated by a court, usually there could be an end date on that. So any type of insurance that you know there's an end date on, you would put into term. Permanent insurance is all insurance needs that will remain with you until death. So there is no end date on that. You know when you die that money will still be owing, or that money will still be needed. The biggest one for permanent insurance is estate planning. So taxes on investments, whether it's property or actual investments that you have in accounts that you would like to pass on to loved ones, there could be tax owing on those investments. And So that person, the beneficiary, would have to pay for that tax. And so you can use insurance in order to supplement or pay for the tax. And remember, it's received tax-free, so that way the beneficiary isn't paying for the inheritance that they're getting. Spousal support, so that's not in a divorce situation. Some couples do require, they're pooling their income, and so they do require the other person's income in order to continue their lifestyle or the lifestyle that they've secured for each other. And so spousal support allows them to continue to do that after their spouse has died. Inheritance, charitable giving, and then of course funeral expenses, all of these things would be something that you would need permanent insurance for. And hopefully that will help you explain the differences between perm and term to your clients.